from our studios in Atlanta, this is CarBiz Today. And here now, Bridget Fitzpatrick.
Hello everyone, welcome to the Kerrigan Advisors Market Update. I'm Bridget Fitzpatrick. Thanks so much for joining us today. Today we're joined by Ryan Kerrigan, Managing Director for Kerrigan Advisors. Thanks so much for joining us, Ryan.
Bridget, good to be with you.
Tell us about the Kerrigan Index's performance in March.
The Kerrigan Index was up a significant 6% for the month, while the S&P was only up 1.8%, so very significant overperformance for the index.
Who were the biggest winners and losers?
Well, four of the component stocks were up, Group 1, Lithia, and AutoNation, but the story here was really around Carmats, which was up over 12% and really carried the index higher. Asbury, Penske, and Sonic posted losses this past month.
What is driving Carmats higher?
Well, as I mentioned, Carmats was up over 12%. The company reported fourth quarter and full year earnings last month and posted increases across the board. Revenue was up 6%, net income rose 58%, same-store sales up 2.8%, so a really outstanding quarter for Carmats.
Got it. Anything else notable on their earnings call?
Yeah, there was. They talked at length about their Omnichannel sales experience, which is currently being piloted in 3 markets. Now, Omnichannel approach provides a seamless buyer experience for consumers as they move from the computer to mobile to the showroom. And the model offers online pricing estimates and appraisals for customers, vehicle home deliveries, and expedited pickups at stores. Bill Nash, the CEO of Carmats, believes this strategy could take significant cost out of the current model, and the market liked what they heard.
And how were auto sales last month?
Well, U.S. light vehicle sales were down 3.1%, so not a great month. That said, SAAR was much stronger than anticipated. The run rate was 17.4 million, which is stronger than many recent months and much better than predictions. So overall, a mixed bag for U.S. auto retail.
Your 2018 Year in Review Blue Sky Report was published last month. What were some of your findings?
Well, one thing that we're really observing is buyers becoming pickier. As SAAR flattens and the economic cycle shows signs of slowing, many buyers are growing more cautious in their willingness to underwrite deals. And this is a classic flight to quality phenomenon that's common in late market cycles. And we're really starting to see that play out in auto retail.
So deals are getting harder to get done?
Yes, I'd observe there are 2 types of situations that are becoming more difficult to transact. The first is underperforming dealerships. In a plateauing environment, buyers are less confident in their ability to improve performance if facing industry headwinds. So while there remain a lot of undermanaged dealerships out there, buyers are wary that they could improve profits at this point in the economic cycle. So these stories are very much harder to get done.
And what's the second example?
Well, buyers are really shying away from franchises that rely heavily upon stair-step programs. These franchises show much more earnings volatility given the complexity associated with these programs. And it's harder to play a volume game in a slowing marketplace. While some of these franchises can be quite profitable, buyers are much more reluctant to step into these franchises today.
So what are buyers looking for?
Well, that's the right question. Buyers now seek strong franchises with good business models. Frankly, the kinds of businesses that can ride through an economic cycle. So they're looking for high sales average per dealership, strong fixed operations, well-funded captive finance companies, and really good dealer relations. We expect top volume franchises such as Toyota, Honda, and Subaru to experience continued growth in the buy-sell market share in 2019.
How do the top luxury franchises fit into the buyer's preferences today?
Well, we'd also expect the top luxury franchise to grow market share as well. That said, as interest rates rise, the higher multiples can be challenging for buyers to justify in a plateauing market. But for buyers with a longer-term buy and hold type strategy, these remain very attractive assets even at today's strong valuations.
And any other market dynamics to discuss?
Well, we've got Q1 earnings coming out later this month for the rest of the publics. There's a really good window into how revenue and margins are holding up in 2019, so we'll have a lot to talk about next month.
Okay, so stay tuned.
Yes, lots of uncertainty in today's marketplace. I think dealers are treading carefully and frankly working harder to make good decisions. There are some great opportunities coming to market, and dealers are weighing the timing of acting on these unique opportunities while knowing that we see clear signs of slowing. So exciting times for those of us in auto retail.
All right, thanks so much for joining us today, Ryan. We'll see you back here next month.
Thank you, Bridget. Always good to be with you.
Thank you for watching the official news source of the retail automotive industry. This has been a JBF Business Media production.